Hey guys, Coach Kelvin here, and today I just want to talk about why more than ever it's important to keep up your dollar cost averaging habits right now, even though the market seems to be at all-time highs. It's very difficult to actually time the market and know when to pull your funds out and buy back in. You essentially have to be able to time the market right twice, okay? You have to know at the high point when you'd want to sell and the low point when you want to buy back in. And being able to predict that is quite difficult, if not impossible. In fact, Warren Buffett actually had a bet where he said over a 10-year period he would allow somebody to win $1 million if they were able to beat the performance of the index through stock picking, and no one was actually able to take that victory. So what you'll find is that you're better off just having your funds invested as opposed to having your money in and out of the market at random times. Obviously, day trading can come with more risk, but it can also come with reward if you tend to get it right. I'm not saying that you will every time, and it's therefore probably more advisable to stay invested in your long-term holds like ETFs, listed investment companies, and track the index as opposed to being, reckless with your money. If you have a consistent strategy and the goal is to hold long term, and you just add your money into the market every single month, year, week, etc., you're going to capture all of the volatility of the market. You're going to buy when the market's low, you're going to buy when the market's high, and over the long term, this will balance out. We just saw that crypto market sort of dip that occurred sort of from June till August, and I was dollar cost averaging in every single month with that. And voila, all of a sudden those funds have recovered. I'm back up to more crypto money than I've ever owned, and it's because whilst I was dollar cost averaging in through that period of time, each of my purchases was actually buying me more crypto with the same amount of money. Okay, so think about this in the same way shares work. Whenever you put your $1,000 per month in, if you use a strategy similar to mine, I put my $1,000 in, and let's say month one I'm able to buy 1,000 $1 units, okay? Obviously that is wonderful. I'm going to have 1,000 new shares of a company. Now, if over the next year that goes up to $2 per share, the amount of units I get for that $1,000 drops down to 500 units. So my same amount of money buys me less shares. But if it goes up to that $2 per share and then crashes 75%, the next time my $1,000 goes in, I'm going to have 25 cents per share, therefore buying 4,000 shares. So you can see that, as the market volatility occurs, by consistently adding money, you're going to capture and sort of balance out the volatility of the market. And over the long term, you'll end up better off because your money has averaged out the price, and you're going to have a current price which sits much higher than your average buy-in price. This dollar cost averaging strategy is a great way to sort of prepare yourself mentally to stay invested and to keep on adding to your funds, because you set yourself almost a contract where you commit to a time period, a dollar amount, and also a minimum amount. So for myself, my absolute minimum that I'm going to invest every single month is $1,000, okay? Now, if I obviously have a cash buffer 1 month and I have an extra $200, I'm going to put in $1,200. But the absolute minimum, non-negotiable amount is $1,000. So adding more obviously helps, but for this example, we'll stick to 1,000. Now, my frequency in which I do this is 12 times a year, or an easier way to look at it is every month. And I commit to when my rental money comes in from one of my properties, that's the money I invest. And I have a strategy. So as soon as I receive that money, I transfer it across. I then buy into the shares that I want to buy. So I want you guys to be very conscious of when you are looking to start a dollar cost averaging strategy, to actually set yourself the restraints and the domains in which you want to set up your investment habit. Because over time, we could find, we forget 1 month because we're on holiday, or a random expense comes up, and if you're not with high conviction on this strategy and setting money aside and saving every month, you will let the ball slide. And whilst before it happens it doesn't seem like a big deal, if you do forget to invest 1 month, you're more likely to then put it off for longer. So keeping up a consistent habit and even potentially automating it is going to be the best way. Now, I personally buy shares through SelfWealth, and I transfer my money every month when I receive my rental income, but I also have a weekly recurring payment into that brokerage account so that I have a bit more of a buffer if I wish to make another purchase of shares, or if I'm covering a shortfall, like my rental income had to cover a water bill or something like that. So I know at bare minimum, I'm always going to have that $1,000 to put into the shares, but quite often I'm able to actually contribute a little more. So I highly recommend that you try and automate the payment into the brokerage account, and then perhaps once a month you set a reminder on your phone to log in. It could be the 1st of the month, the 5th, whenever you want, but make it recurring. So you get a response on your phone or a reminder and it says, buy shares today. So you log into your brokerage, you put in your buy order, you close the app, and you don't look again until the following month, unless you like to look at your portfolio a little more frequently. I know I like to at times. That way, you consistently have that reminder. You're never going to have cash drag because your money is sitting uninvested, and you're going to have that consistent and repeatable behavior of always having money to put to work. I can't even fathom the idea of not investing now that I've done this for over 2 years, and every single month without fail, I have committed and contributed that $1,000, and I won't be touching that unless I absolutely have to or I reach early retirement. In the meantime, all my dividends are reinvested. Any capital gains sit unrealized because I have not sold. And over time, I'm going to build my wealth to a level that I can eventually live off. So it's important to figure out what your investment goal is, how much money you would need to live on in early retirement, or how much capital you need to have to sell down to be able to then use that money. You need to figure out what dividend yield you need to have, etc. And then from there, you look at your living expenses. How can we cut these expenses back so that my average cost of living every week is less? Because every time you can cut an expense, that gives you more investable capital. So, for example, if when I start my investment journey, I'm only able to save and invest 5% of my income, it's going to take me a very long time to get to the point where my expenses are actually covered by my cost of living 25 times, which would give me a 4% drawdown rate of safety. So if you are able to then increase that savings and investment rate from 5% to 20%, we've not only increased our investment amount by 4 times, but there's a bigger amount of money that's able to compound over time. So you're going to reach the goal much quicker. It's actually exponentially quicker the more you're able to save and invest, okay? So whilst it seems like it'll happen 4 times quicker, it'll actually happen much quicker than that. And this continues to occur up that curve. If you can increase your savings and investment rate to 50%, the time it takes to retire is less again. So the more expenses you can cut, the more money you can invest earlier, which compounds for longer, which obviously increases your net worth and your income that's able to be generated by your investment pool. Your greatest power or superpower when you are an investor is time. So the earlier you get money invested, the better. And I highly recommend you try and at least get up to that $100,000 mark as soon as possible by being relentless in cutting back your unnecessary expenses and trying to divert all of your fund into these investments. After that, if you have $100,000 investing and it's earning, the stock market average of about 8% per year, after 1 year, you should theoretically have $108,000. So this is going to just grow that pool over time. Obviously, we then earn 8% on that 108,000, and this goes on forever. So if you are able to get more money in earlier, that compounding effect is going to supercharge how fast your money grows. Whereas you wait 10 years and then start investing, even if you make bigger contributions from the start, you're not going to be able to make up for that lost time, that 10 years that you've put it off. So definitely get more money invested earlier. Focus on, creating really good psychology for investing so that you never deviate from your plan. Obviously, unless you change your plan for the better or your investment class. But the more you can automate these habits, the more you can, create that smart contract with yourself or even look to your friends for accountability. You know, make a pact that we'll all invest $1,000 a month, or 2,000, or 3,000, or whatever you can do. That's going to be exciting to talk about when you have that catch up for a coffee and you go, you know, oh man, I just put $1,000 into this ETF. You know, I look at that as it saved me 4 days worth of my life per year. That's pretty cool. So I recommend definitely getting that sorted. Now guys, I think when it comes to dollar cost averaging, there is no better strategy or no better tool, because mentally it makes the most sense. You don't have to time the market ever, whereas if you lump sum in, if you just saved up for a whole year and then wanted to put it in once, you're constantly going to be overthinking, have I bought in at the right time? Is the market high or expensive? Is it cheap? Is it low? It's very hard to get right. Adding every month takes out all of that overthinking. It just becomes a repeatable habit, just like brushing your teeth before you go to bed every night. Alright guys, thanks for watching my video. If you got any value from this, please like, share and subscribe. It helps out a lot, and I really look forward to seeing you in the next video.